Sandro, welcome to the Family Business Show today.
Thanks, Amalia. It's nice to have the tables turned, isn't it? Because you were a rather wonderful podcast guest of mine some months ago. So now I'm in the hot seat.
Now you're in the hot seat. I'm going to be grilling you because you are, such a wonderful expert in terms of in people's finances and planning for the future. And I just thought, because last week we had the Chancellor's budget for 2021, and everyone is obviously thinking about how does that affect me, my family business, my family, the livelihoods of those I employ. I think the future's been so uncertain for so many people for so long that now we actually have some sort of roadmap out of the pandemic. Families and businesses and business owners can start planning for the future. And I think you're expertly placed to help people do that. So should we hash that out today?
Yeah, let's manage people's expectations. I mean, although I do have the requisite qualifications and I have been running a business, I like to think successfully, for 30 years. I'm by no means an expert, but I'll do my best.
Okay, so Rishi set out last week a sort of 3-point plan, and he says here to protect jobs and strengthen public finances. And his 3 key points were billions to support businesses and families throughout the pandemic, which we've already seen so much of. Investment-led recovery as the UK emerges from this lockdown, and future changes to strengthen public finances.
Yeah.
And obviously that's going to mean so many different things for different people. So why don't we pick out some of the key points for people running family businesses at the moment and how that can impact them immediately today. I did note that in his talk, he said 700,000 people have lost their jobs because of the pandemic. I mean, that is just such a horrible, horrible statistic. But the wonderful thing about family businesses is they are providing jobs for over 13 million people around the UK. So that's phenomenal in itself. They are such a huge part of the UK economy, and I think very often don't get that recognition, actually. So first off, to say to anyone watching this, if you're running a business and you are providing jobs and you are still here, your business is still living and breathing, then hats off to you. So what are some of the biggest impacts that businesses are going to see moving forward now?
Well, I think the first thing to say, Marley, is that the one thing the Tory government, of course, announced in its manifesto that there was going to be no tax hikes. So, of course, the Chancellor couldn't go down that route. Otherwise, it would have completely blown their political standing and almost certainly would have led to a loss at the next election. So we know that the personal tax side of things has remained unchanged. That doesn't mean to say there aren't going to be some changes in the future. But one of the things, as you've already pointed out, and it is worth making this point, that what makes Britain great is the fact that we do have this kind of bedrock of family businesses. And our country has become synonymous really with family business and family business-led enterprise. So clearly the Chancellor recognises quite rightly that he has to do as much as he can to maintain stability in that particular sector. So one of the most obvious things that we've seen is an announced hike in corporation tax, and that's set to rise from 19% to 25% in April 2023. So we've got this 2-year window to do some, pretty serious planning. But there's going to be a reduced rate for smaller businesses moving forward. The other area, of course, is VAT. An area a lot of people don't understand. A lot of people see as a very unnecessary, quite punitive tax, and we've seen VAT rise steadily over the years. But what we know, and talking about family-led businesses, there are a lot of family-led businesses in the hospitality sector. And I start with that simply because my family originates in the hospitality sector, still does run a very successful business, having many, many years ago, my great uncle Charles built the biggest hotel group in the world. So hospitality and its industry is very dear to me. It was really good to see that the Chancellor is basically maintaining the reduced 5% VAT threshold for a rate for hospitality-led businesses until September. And then there's going to be this interim VAT charge of 12.5% to apply for the following 6 months. So this kind of gradual reintroduction of the former VAT rate to hopefully kickstart, a very massive part of business and economy in the UK. There's going to be a whole range of other incentive grants for apprenticeships, to rise to £3,000, £126 million being pumped into traineeship. So trying to get some of those 700,000 people back to work, and particularly those, you know, who must be leaving university now thinking, oh my goodness, you know, what the heck am I going to be doing moving forward? £5 billion into restart grants for shops and other businesses that closed due to COVID. So real effort, all of the money really being put into trying to kickstart the economy, re-establish businesses that have, you know, particularly those that have suffered during the last 12 months or so. A lot of businesses, family-led businesses in the transport, environment and infrastructure sectors. So there's going to be a new infrastructure bank with a £12 million of new capital, with the aim of £40 billion worth of public and private product funding, £17 billion, £15 billion in green bonds for retail investors. So loads and loads and loads of money being pumped into helping family-led businesses in particular to re-establish themselves, to recover from the economic mess that we found ourselves in.
Absolutely. And something which came up in the budget that not a lot of people, and I certainly didn't understand, was about the free ports. And now that I've read up more on that and these new 8 free ports around the country, there are so many family-run business involved in importing, re-exporting, and particularly in areas of the country which have seen that great divide between the north and the south. Places like Hull, which, you know, are really on the up and are putting lots of money and investment into their infrastructure and people doing business up there. So that's an exciting time now that we've left the EU. Whether you're a Brexiteer or not, there are some opportunities out there for family businesses to start doing things and doing things independently of the EU, and that's very exciting. And something else which a lot of our members have made the most of is this Kickstart scheme for employing 18 to 25-year-olds, which may not have been a demographic you might have looked at before. You might have thought, oh, they haven't got enough experience, or, you know, they haven't worked in our industry before. But actually opening your eyes to someone who is young, who is hungry, who has got the skills of that sort of digital generation, there's something to be said for embracing that. And I think that Kickstart scheme can be really, really powerful for family businesses, where they can offer such a wonderful, nurturing family, if you like, as a business. For someone young, like you say, coming out of university or coming out of college, family businesses often make really wonderful companies to work for. So I would encourage anyone out there to really investigate that as well.
Yeah, in fact, before we had this call today, Malia, I was speaking with a family, a long-standing family business that, you know, has suffered in the last 12 months. But we were talking about the fact that, you know, with every challenge in life comes an opportunity. And what they're finding in the restaurant sector is that a lot of, you know, landlords are now negotiating rents for the first time in probably 2 decades. You know, there is a buying opportunity out there. A lot of businesses, particularly in the restaurant and hospitality sector, that maybe weren't quite at the cutting edge of the market, just fallen away. They were surviving, but what they were doing, taking customers away from the really good businesses, they're starting to fall away, which is creating a new opportunity. This particular business was in Sevenoaks in Kent, and now they see actually a new opportunity, probably the best opportunity in a decade. So what I would say is 2 things. One is really understanding every part of the fiscal stimulus that's been put forward. That's a very important part of this process. You know, there is an awful lot of financial support available, and I think also recognizing and embracing the fact that despite the difficulties that we've all experienced over the last 12 months or so, there is a new opportunity. You know, people talk about buying and selling property, buying and selling stocks and shares. There is a new investment opportunity in Great Britain in 2021. And I think we should, if we can, we should embrace it.
Completely. So we've talked a little bit about businesses, and obviously when you're talking about family businesses, the two are very sort of intertwined, aren't they, really? And there's one thing planning for your business and making a business plan and any investment going forward there, but then there's also, you know, talking about your own livelihood, your own family and your own wealth, because, you know, anyone that runs their own business, it's 24/7. You put in your blood, sweat and tears, and what's it all for? And I think 99.9% people would say it's to provide for their family and to give their children opportunities in the future. Now, let's talk about that side of things.
Okay, so this is an interesting one, because for 31 years, what I've found time and time again, Amalia, is that a lot of people who come to me for advice will talk about, broadly speaking, three main areas of financial planning. And there are various offshoots, so we'll explore those briefly. But broadly speaking, income tax, capital gains tax, inheritance tax, they tend to be the three big topics. And the general principle is, if you've got a pound, Amalia, and I've got a pound, and your pound is taxed, and you invest your pound, one to tax, and I invest my pound that is not taxed, I'm going to make more money than you are. So what's really interesting is that we all bemoan the fact that, you know, we live in a highly taxed environment, but actually there are some extraordinarily generous reliefs and exemptions that are available to everybody. So although, unfortunately, from my perspective, the personal income tax threshold beyond which you start paying tax at 20% has risen from £12,500. It was a lovely, nice round number before. Now I've got to unlearn that and learn a new number. But it's £12,570 frozen for the next couple of years. And you can understand the reason why the Chancellor would want to freeze allowances, because it means that they can collect more tax without increasing the tax rate, which of course was what they promised to do. But at £12,570, every person can earn up to that amount of money without paying income tax. So what we tend to find, particularly in family businesses, is everyone gets paid a basic salary, let's call it salary, PAYE, taxed on under Schedule E, and the rest will be taken as dividends, generally speaking. And the reason for that is the income tax rates are 0% up to £12,570, then 20% up to £50,000, and beyond £50,000 it's 40%, and once you go above £150,000 it's 45%, and most people know that. What most people don't know is once you earn in excess of £100,000, you lose the personal allowance. That's the £12,570 that I just mentioned. That's your tax-free income. You lose that at the rate of £1 for every £2 of income you generate in excess of £100,000. So to keep that nice and simple, at roughly £125,000 of income, you are being taxed at 20% on the first £12,570 rather than at zero. So you're paying an extra £2,500 a year in unnecessary tax because you've disregarded the fact that this relief and this exemption applies. So that's the first thing I would say. Most people tend to take dividends simply because the dividend rates at 7.5%, 32.5% and 38.1% are lower than the income tax rates that I've just mentioned. However, the difficulty is, and as a general tax principle, whatever you take with one hand from HMRC, you give back with the other. So this is why taking dividends is not always the best idea. I'm not saying from a tax perspective it's not a good idea, but dividends are not treated as what we call earned income. So you can't include those if you're applying for a mortgage, for example. You can't include them if you're trying to make a pension contribution. However, another little rule, a relief, an exemption, if that's what you want to call it, that a lot of family-owned businesses don't know about, is if you own a company, most family businesses are set up under limited liability companies, one of the things that you're allowed to do is make pension contributions from the company, and as long as they fall under what's called the wholly and exclusively rules, in other words, as long as they're justified, that's probably the simplest way I can put it. So let's imagine you and I run a business together, we're husband and wife, we're responsible between us for 100% of the profits. We don't have anybody else working for us, and we make £100,000 with the profit. Technically speaking, we could justify a pension contribution of £100,000 between us because we are generating that profit wholly and exclusively within that business. So although you might be taking dividends, which are non-earnings and therefore not pensionable, there are other ways to make pension contributions. The other thing you can do, if you've got income in excess of 100,000 or just above one of the thresholds, maybe 50,000 or 150,000, you can make a pension contribution. You can actually increase your salary and then what we call sacrifice that salary. You basically have an arrangement with your own employer. So for a family-led business, that's yourself, probably. But you have an arrangement with yourself that basically says, right, Amalia, I've just given myself a £20,000 pay rise, but you will say in response to Amalia saying to you, here's £20,000 of extra income, you will say in reply, well, that's very kind of you, Amalia, but I don't want the £20,000. I'm willing to sacrifice that. And what Amalia then does, Amalia A, then says in reply is, that's fine, Amalia, what we'll do is put that into a pension for you. And so what you do is get the benefit of an increased salary, albeit tax efficiently, then able to save that for some future date. As we know, you can earn up to £2,000 of dividends without paying any tax. And actually, although this is pretty rare at the moment, there is also a little tax called savings tax. You can earn up to £500 of interest on your savings before you pay any interest if you're a higher rate taxpayer, and £1,000 if you're a non-taxpayer. But you need to have a fairly substantial amount of money on deposit to attract, at the moment, at rates, 0.01%, if you've got money on deposit, to attract enough interest to be paying tax. And that's actually a reason why you might not necessarily invest in, say, a cash ISA, because actually cash ISA rates tend to be, in some cases, lower than deposit-based rates. And if you're not paying tax on your savings, actually, why would you want a cash ISA? Now, that's a different conversation if you're having a think about long-term savings, where you might have a conversation, for example, about stocks and shares. So that's the kind of the income tax, dividend, savings tax regime. Capital gains tax, a tax, as we know, chargeable on profits on things like property, second properties typically. There's no capital gains on your primary residence. Things like stocks and shares, art collections, fine wines, car collections, and all the rest of it. So we know what capital gains tax is. Basic rate of capital gains is 10%, 20% if you're a higher rate taxpayer. And there is this thing that used to be called entrepreneurs relief, where you could earn up to £1 million if you were disposing of a business. The first £1 million would be chargeable at 10%, everything after at 20%. So a lot of those things are still in place for the foreseeable future, at least long enough to give us some serious planning opportunities to defer capital gains tax. So if there's a capital gains tax that's crystallized now, maybe you've just disposed of a second property, maybe you've vacated some premises that you've sold, maybe to help the business, for example. There are ways that you can defer the capital gains tax and then access profit from the overall gain over a period of time, because everyone also has a personal allowance when it comes to capital gains tax as well. And if you're a husband or a wife, you're married, you can pass your gains to the other person. So one of you might be a higher rate, one of you might be a basic rate taxpayer, ways to either mitigate or to defer tax as well. Many family businesses are set up under an EIS and SEIS structure. Very useful for investors to park gains, defer them to some later date. And then probably the voluntary tax, which is inheritance tax. This has been talked about for years and years and years and years, where people sort of say, so let me get this right. I pay income tax on my income for the whole of my working life. I pay income tax on my pensions when they eventually come into payment, including the state pension. And I've got to pay capital gains tax if I sell something at a profit. And then when I die, I've got to pay 40% on everything I've built up over the years. And that does stick in the craw of a lot of people. However, very, very little revenue is generated from inheritance tax, for the simple reason that with the right advice, capital gains tax is an entirely voluntary tax. So a lot of people say, particularly the older generation, the baby boomers and above, they grew up in a world where it was give it all away or die with the asset, and then somebody pays 40%. Fortunately, tax planning has become much more sophisticated, and now it's possible actually to invest assets, retain control of them, and dispose of assets from an IHT, an inheritance tax perspective at the same time. There are all kinds of weird and wonderful, very legitimate. I should add a caveat here, Amalia, that every bit of advice I've ever given to anyone has always been tried and tested. None of this, well, we've got a barrister's opinion. If you ever hear the words, we've got a barrister's opinion, leave well alone. If it's been through the courts, it's been challenged by HMRC, and HMRC have lost, then it's a very legitimate opportunity to invest or mitigate tax. But anything beyond tried and tested, do not touch. Generally speaking, lots of ways to solve all of the tax problems, which of course, if you can take full advantage of your reliefs and exemptions, by definition, you are going to give your income a boost, your EBITDA a boost, your corporation tax reduced, and therefore more profit overall. There are lots and lots of ways which we're never going to cover during the course of this conversation. But suffice to say, lots of ways to mitigate tax and therefore increase wealth. That was a lot, wasn't it, without pausing for breath?
That was good going, but really nice to hear it in sort of layman's terms, really. And there's just, I think when you run a business and also you have a family, there's just so much to think about. And you've probably got an accountant for your business and they're helping you plan and they're giving you the best advice. But very often people don't realise or think they need to bother with someone to think about their personal planning for that of them and their family and the future. And so, like you said earlier about opportunities coming from adversity, there are so many opportunities now to, like you say, boost your wealth, mitigate your risk, your tax. I think you need to sit down with someone who knows what they're talking about and just plan it. And there are so many things that, us average Joe Schmo don't understand. We may not be particularly financially minded like that. We're brilliant at running our business and building our team and building our people. But financially, some people just draw a blank. But just sit down and ask. There are so many people out there who can help.
Yeah, I think you just touched on a point that is worth me just following up on, if that's okay, Amalia. A lot of people are kind of wedded to this idea. When we talk about financial planning, let's be honest, it's a very dry subject. When I say to people, I'm a financial advisor, but please try not to hold that against me. But the reality is that a lot of people are kind of wedded to this idea of financial planning, whereas you don't have to financially plan all the time. In other words, what I mean by that is people are obsessed with this idea maybe of investing into pensions. Well, if you've had a really lean financial year, don't invest into pensions, because what's the point in funding a pension and getting all that lovely tax relief if you've got an overdraft? And that makes no sense, because, but the point I'm going to go on to make is that although today may not be the day to make the pension contribution, to make the new investment, then in the new financial year, when things improve, the great thing about the pension regime is you can go back, ironically, we call it carry forward, but you can go back 3 years and mop up, a bit like EIS, you can go back with EIS to the previous tax year and pull through tax relief that you would have received last year into the current year. And the same is true of pensions, except you can go back for 3 years. So let's imagine you had a poor financial year in the last 12 months. But then what you did was you made a lot of profit in the next tax year. You can then go back to the pension contribution you would have made the previous year, except you didn't have the money to do it, and make the contribution in your next financial year, get the same tax relief that you would have done, but in a period where your cash flow allows you to do it. So you don't have to, again, if somebody's paying things like pension contributions on a monthly basis and is thinking, this feels really painful because we're really struggling at the moment, stop paying into pensions. Just, suspend the direct debit, whatever it is you're doing, and reassess the position in 6 months or 12 months' time. Because good financial planning is about enjoying the experience. It's about feeling comfortable. It's about not taking from another area of your business just to satisfy a particular need now. It can be really flexible. And I do say to people, when they talk about, they've maybe met another financial advisor who said, invest every spare penny you've got saved. I call that transactional advice. They're always after the money in the bank and the maximum pension contributions, but cut your cloth accordingly and don't be afraid to just take stock, pause, stop doing things for 6 months. I mean, I'm not saying cancel the insurance policies if they're really important to you, but certainly in terms of long-term savings, if you're 30, 40, 50 years old and you miss a year, it's okay. It's not going to damage you long-term. So I think sometimes this is where good advice is just as important. It's about when to stop, when to start, when to increase, when to decrease. And ultimately, a good financial plan is a 20, 30-year thing. It's not a 12-month thing.
That's a really good point, actually. Okay, so I know because you're regulated, you're not allowed to actually give advice to our audience. But are there maybe a couple of things, a couple of top tips that you could say to anyone running a family business now to just go away and think about, or to, you know, maybe go in action, something they can do today and take away from this?
Yeah, I think, well, the first thing, as you know, Marley, we did was we tried to put a kind of a key announcement at a glance, a summary of the budget, because, you know, when you hear the Chancellor stand up in the benches and delivers this budget speech, I mean, for most people, with great respect, it's like a different language. And they always rely on somebody to come up with a kind of a one-page, okay, what did all that mean summary? So that's the first thing that we did, which is available through the platform that you've created so brilliantly well. That's the first thing. But I would say, in answer to your question, gain a really good understanding. And when I say understanding, we're not talking about, you know, degree understanding. We're talking about understand the basics. How do I maximize profit? How do I maximize income? What are my reliefs? What are my exemptions? Because there is probably, well, most people can earn up to about £25,000 a year without paying any tax. So, you know, if you've got 3 or 4 members of family, that's £100,000 of income before anybody pays any tax to anybody. So really understand the rules, the reliefs, the exemptions, because there are lots of them out there. That's the first thing. Second thing is, everybody's found the last 12 months difficult. Don't be afraid to reach out, speak to somebody about consolidating some of the things that you've got at the moment. And as I mentioned before, Amalia, you don't have to commit to the things you've been doing for the last 5 years when things were good. Take a step back, redirect your energies, understand that the business might have different priorities at the moment, and it's kind of okay to take 12 months off from doing any kind of long-term planning. But I think third point is, whatever you do, do something positive. You know, take a step forward. Thousands and thousands of success stories have come from people who had a great idea, had a desire to do something, had a goal, and just did something about it. I know so many well-educated failures. I know so many people that had a dream, had a great business idea, and are still talking about it 20 years after they first had it, but just did nothing about it. I'm a great believer that whatever you do, you know, take the right advice, communicate within the family business place, speak to other people. Education, let me rephrase that, understanding is such a powerful weapon to the success and the profitability of a business. Understand as well that there's lots of other people and businesses, particularly family-based businesses out there at the moment, who've got the same challenges, the same issues, the same obstacles to deal with. And what they have got within Family Business Place is unlimited resources that will help them fix the vast majority of these problems and challenges.
Completely. And I think as we start coming out of survival mode, what you said just then about just do something to take a step forward, because we're so embroiled in the day-to-day firefighting. And I think lots of family business owners have really had to get their hands dirty over the last 12 months in trying to figure it out and survive. But now is the time to come up for air, take stock, like you say, and just do something to move forward in whatever aspect of your life, even. That will just help you feel like you're going somewhere.
You mentioned accountants earlier on, and I've got some great associations with many, many great accountants, and this is by no means being disrespectful to them. But accountants are brilliant at adding the numbers up and generally speaking, telling you how much tax to pay. But there's an element of strategy that I would encourage most people to think about. And what I mean by that is, you know, really you should be thinking about every 3 months, sitting down, looking at the financial position, taking stock, and creating an action plan around the strategy of tax planning, not simply waiting to the end of your tax year and then being given a number, because by then it's too late to do any serious financial planning to reduce your tax liability, increase your income, redirect some of your savings and financial resources. So strategy, every bit as important as the numbers at the end of a year as well.
Fantastic. Sandro, I just think you come from such a wonderful family history legacy, but also have this head on you. And I think you're such an invaluable resource to your fellow members at Family Business Place. So thank you so much for sharing those insights for us today. And I think certainly for me and for anybody watching, to actually start thinking, some light bulbs have gone in my head, to start thinking about doing something proactive in terms of planning for the future. So thank you for making that really normal and understandable.
Yeah, it's, as I say, one of the driest subjects, but hopefully if that didn't make sense, then I'm very happy to talk to anybody. As you know, Malia, the way I run my business is very, very happy to talk to anybody, give advice. There's no cost or obligation. I'm a relationship person. If I can help anybody in the community, very happy to do that.
Brilliant, thank you so much. So we'll send this video out and we'll have access to your breakdown of the budget and what that means for businesses and for entrepreneurs and families, and we'll send it all out together. But as you know, anyone can give you a call, get in touch and just talk to you and just brainstorm things with you. So thank you so much for your time today and for being on the Family Business Show.
Pleasure, and thanks for being so gentle.